85% of retail investors believe the gold in Fort Knox is gone, stolen, or replaced with gold-painted lead. Trump and Elon Musk want to open the doors. They want a live audit. But while retail is panicking over a hollow vault, the smartest money on Wall Street is completely ignoring the drama. Look at the massive gold mining conglomerates like Newmont and Barrick. They are completely silent. If the world's largest gold reserve was truly empty, it would mean a historic overnight drop in global supply, and mining stocks should be exploding to infinity right now, but they aren't. Why is smart money dead silent while the public panics? Because behind the political headlines and the conspiracy theories, Wall Street knows something you don't. They're watching a completely different set of data, a signal hidden beneath all this noise. If you are holding gold or silver because you think Fort Knox is empty, you might be looking at the wrong map. The real crisis isn't what is missing inside that vault, it is what is happening right outside it. For the past several months, your social media feeds have been flooded with the exact same story. Headlines scream about Fort Knox, political commentators are demanding answers, and the internet is convinced that the most heavily guarded vault on the planet is entirely empty. This isn't just random online chatter, it's scaled all the way up to Capitol Hill with the Thomas Massie bill. Then, Trump and Elon Musk openly questioned the integrity of America's gold reserves, demanding a full, transparent, live-streamed audit, and the public is eating it up. A massive poll recently showed that an astonishing 85% of retail investors genuinely believe that America's 5,000 metric tons of gold are simply gone, melted down, leaked into the shadowy depths of the global financial system, or replaced with gold-plated tungsten bar decoys. And that fear is highly contagious. When everyday people believe the bedrock of a nation's wealth has vanished, they don't look at charts, they look for safety. Because of this headline drama, retail investors are rushing into physical gold and silver at a frantic pace, paying massive premiums to local coin dealers, waiting weeks for deliveries, and hoarding metal in private safes, driven by a singular, terrifying thought. If the government is lying about the gold, the entire monetary system is a house of cards about to collapse. And mathematically, their logic makes perfect sense on paper. Think about basic supply and demand. If 5,000 tons of sovereign gold suddenly cease to exist, the global nominal supply of gold instantly shrinks. This wouldn't just cause a mild market rally, it would trigger a violent, unstoppable hyperinflationary spiral for precious metals. Spot gold prices would instantly launch into a permanent hockey stick trajectory, silver would squeeze to historic multiples, and it would be the ultimate vindication for every hard money advocate since 1971. But that is not the real story. While the retail crowd is hyper-focusing on the drama outside the gates of Fort Knox, they're completely missing the actual mechanics of the financial markets. They are trading on pure emotion, buying into political theater. Because behind the headlines, there is a massive disconnect between what the public believes and how the actual market is behaving. Investors are being led by noisy political narratives instead of cold asset valuation. If this world-changing supply deficit were a real immediate threat, the megafunds would be aggressively positioning for it. The megafunds would be locked in a buying frenzy, but they aren't. Retail investors are running headfirst into a psychological trap. They are looking at a political magic trick while the real economic threat is developing somewhere else entirely. And this is where things get dangerous, because when you buy an asset based on a headline drama instead of structural data, you become blind to the actual risks. You ignore the real forces that control the price of what you are holding. And right now, the biggest gold producers on Earth are looking at a completely different set of numbers. They aren't looking at Fort Knox at all. They are looking at the charts. And what those charts are revealing is an entirely different reality. To understand how deep this illusion goes, you only need to look at one specific chart, the cold mathematical reality that shatters the entire Fort Knox conspiracy. Pull up the chart comparing the spot price of gold against the GDX, the primary exchange-traded fund tracking senior gold mining stocks.
If you look at the price of physical gold, it has been on a historic run, breaking records and pushing into uncharted territory. If the market genuinely believed 5,000 tons of global reserves were missing, mining stocks should be leading this charge. They should be surging past their previous highs as investors scramble to buy the companies that physically dig the remaining metal out of the crust. But look closer at the GDX. Look at Newmont. Look at Barrick. They aren't exploding. Instead, they are lagging behind, shockingly. They are choppy, broken, and truncated. This is the ultimate twist. Spot gold is printing all-time highs, while the very companies producing that gold are struggling to capture the same momentum. If a massive sovereign supply vacuum was real, this disconnect would be fundamentally impossible. And this is where things get dangerous for retail investors, because behind the headlines, the massive hedge funds and smart money pools are completely ignoring the internet rumors. They are not looking at Fort Knox, they are looking at a brutal metric called AISC, all-in sustaining costs. This single metric is what actually dictates corporate survival and profit margins in the real world. AISC represents the total economic cost to produce a single ounce of gold, including corporate overhead, exploration, and sustaining capital. And right now, those costs are skyrocketing. The mega funds know that a higher gold price does not automatically translate to higher profits if your input costs are rising just as fast. Think about what it takes to run a massive industrial-scale mining operation. You need massive amounts of diesel fuel to run heavy machinery, and energy costs have locked into a structural inflationary spiral. You need specialized, high-skilled labor, and labor costs are soaring across the Americas and Australia. But there is an even deeper bottleneck that retail investors completely overlook: physical infrastructure. Heavy machinery requires highly specialized electrical equipment to function. Look at industrial electrical transformers, the massive units needed to regulate power grids at remote mining sites. The global supply chain for these transformers is utterly gridlocked, and lead times have ballooned from a few months to several years. Smart money understands that a mining company cannot capitalize on high gold prices if it cannot plug its equipment into a stable, functional electrical grid. So while the public debates political theater, institutional capital is focused entirely on these structural bottlenecks, pricing in inflation, supply chain friction, and rising corporate debt. If you are allocating your hard-earned capital into mining stocks simply because you believe a political narrative about an empty vault, you are taking an immense, uncalculated risk. You are completely blinding yourself to the fundamental factors that actually determine corporate earnings, ignoring fuel costs, labor constraints, and equipment shortages. You are buying a story while Wall Street is trading the math. Because behind the headlines, institutional capital does not need the heavy steel doors of Fort Knox just to validate their positions. Smart money is completely indifferent to whether Elon Musk or Donald Trump gets a guided tour. They do not need to look at physical bricks to believe in the value of gold. They are looking at something far more transparent and far more terrifying. They are looking directly at the Federal Reserve's balance sheet, watching the numbers relentlessly tick upward on the U.S. debt clock. This is the deeper implication that retail investors miss. Wall Street understands a fundamental truth about the global financial architecture. Fort Knox is not a practical ledger, it is a psychological monument. And the proof is hidden right inside the government's own accounting system. If you look closely at how the United States Treasury actually books its gold reserves, you will find an absurd, archaic reality. The U.S. government still officially values its gold at a fixed statutory rate of just $42.22 per ounce.
It is a frozen metric from 1973. Think about that. On paper, the state-backed balance sheet treats gold like an obsolete relic. But Wall Street knows this is a deliberate structural illusion. The true value of gold does not fluctuate based on whether a secure vault in Kentucky is missing a few pallets of bullion. The price of gold rises because the purchasing power of the fiat currency used to measure it is systematically dying. The mining conglomerates are indifferent to the audit drama because they understand the core math. The value is not created by scarcity inside a mountain. It is created by the sheer unbridled velocity of the printing press outside of it. Governments can print trillions of paper dollars, euros, and yen out of thin air, but they cannot print a single ounce of physical gold or silver. And this is where the future scenario becomes mathematically inevitable. We are rapidly approaching a critical macro threshold. As sovereign debt spirals completely out of control, interest payments on that debt are beginning to swallow entire national budgets. When that threshold is crossed, institutional funds cannot risk holding depreciating paper promises. They will not move into hard assets because of an internet rumor or a political speech. They will move because the raw mathematics of inflation forces their hand. When systemic confidence erodes, a massive, multi-trillion-dollar wave of institutional capital will automatically rotate into physical commodities and Tier 1 monetary assets. It will be an algorithmic flight to safety. They won't care if Fort Knox is a fully stocked fortress or an empty room. They will buy hard assets because the survival of their portfolios depends entirely on holding something tangible that cannot be inflated into oblivion by a central bank. If you want to survive the coming structural shift, you need to stop trading the political noise. You need to start hedging the systemic math. The political battle over auditing Fort Knox is just the tip of the iceberg. The dramatic bills introduced in Congress, the public demands, the social media viral loops, they are all part of a grand theater. The financial elite on Wall Street do not care about the mystery behind a granite wall in Kentucky. They do not care if the doors are opened or kept shut. They are focused entirely on a much bigger problem, the structural decline of the fiat currency system. They care about the purchasing power of the money in your pocket. So ask yourself, will you keep standing outside the gates, waiting for politicians and billionaires to show you what is inside? Or will you start looking at the real signal, the mining costs, the structural infrastructure constraints, and the unstoppable expansion of sovereign debt? The smartest players are already protecting their wealth based on macro realities, not internet rumors. They are managing risk while the crowd chases drama. Now, I want to hear from you. Where do you stand? Do you belong to the 85% who believe the gold in Fort Knox is completely gone? Or do you think the entire debate is just a distraction from the real economic math happening right in front of us? Drop your thoughts in the comments below. Let's map this out together. If you want to stay ahead of the crowd and decode the actual mechanics driving the gold, silver, and macro markets, hit the subscribe button, turn on notifications, don't trade the noise, and position for the signal. Thank you for watching, and I will see you in the next analysis.